So Campbell's essentially just walked away from discounting their bakery products entirely, purely to stop bleeding margin on the shelf. Welcome to Earnings Unscripted. Today is June 8th, 2026, and we are unpacking the third quarter for Campbell's, ticker CPB. And, Miro, this was a distinctly frosty print.
Yeah, frosty is the right word. The numbers reflect that exact defense mechanism. Top line fell off sequentially by roughly 7.7% to $2.36 billion, and EPS dropped to 41 cents from 48 last quarter. They are, consciously choking their own sales volume to protect profitability.
Right, which is a wild choice for a consumer staple. And quick reminder here that our morbid fascination with corporate snacks is just personal opinion, not financial advice. So please do your own research. But honestly, did the strategy even work? Because gross margins still shrank to 27.5%.
Well, no. It was not enough. They dropped almost 200 basis points year over year. Between brutal tariff impacts and just extremely stubborn input costs, the gross profit was, I think, down over 9% quarter on quarter to $650 million.
That is painful. So how did the market handle it?
Weirdly well, actually. Pre-market was incredibly volatile. It spiked up and then violently rejected at the bell, down to $21. But anchored against yesterday's close, the stock finished virtually flat, down maybe 0.5%.
Flat? With top and bottom lines dropping double digits?
Well, look at the last 3 months. The stock already bled out 26% leading up to this. The bad news was basically fully priced in. I think the market is much more focused on what the CFO flagged for next year.
Oh, the oil warning?
Exactly. They are warning that if oil sits around $100 a barrel, they get hit with an unmitigated 5 to 6% core inflation wave. Freight, packaging, fertilizer. It is bad enough that management openly admitted they might issue pricey hybrid debt just to save their investment grade rating.
Which is an accounting nightmare we will definitely get into. But actually, my favorite moment from the call was the CEO casually admitting that half of their condensed soup is never even served as a meal.
Right, the cream of mushroom revelation.
Exactly. People just buy it as a cheap cooking ingredient for casseroles. So now they're actively pivoting the whole brand to be like concentrated flavor sauces. It's brilliant, but kind of sad.
It is highly practical, and it shows you exactly where the consumer is right now, stretched thin and cooking at home.
True. All right, let's get into the details of that hybrid debt and what's actually happening in their supply chain.
Yeah, so on that debt front, it is actually a fascinating piece of financial engineering. Look, they just spent heavily to buy Sovos brands. Their overall leverage is up. So the CFO openly admitted they might just issue hybrid debt. And he said, quoting here, "As some of our peers have done, we will consider hybrid debt instruments to try to make the rating a little bit stronger than it normally would be."
Which means what? Paying a structurally higher interest rate just to keep the credit agencies happy?
Exactly. They eat a higher coupon, usually roughly 150 to 200 basis points higher, but the rating agencies treat 50% of it as equity, so your leverage ratios magically look healthier on paper. They are essentially hacking their credit metrics.
Right. So they are literally buying a better grade. But that comes directly out of the bottom line, right? I mean, that eats into earnings.
Oh, completely. It is a noticeable drag on EPS. But the CFO was incredibly blunt about it. He told analysts, maintaining that investment grade rating is an imperative to the management team. It's an imperative to the board. So they are just fully willing to pay the toll.
Honestly, that is refreshing transparency. Normally, you get this whole corporate word salad about optimizing capital structure and maximizing flexibility. But here, he is just saying, look, we need the rating. We are paying the fee.
Yeah, precisely. But you mentioned the supply chain earlier, and this actually connects to a massive accounting trap they are setting up for Q4.
Wait, you mean the La Regina deal?
Right. So literally one day after Q3 closed, they finalized buying 49% of La Regina. These are the suppliers over in Europe who actually make the Rouse pasta sauce. Operationally, it is a brilliant move. You lock in the core asset.
Right, you own the sauce.
Exactly. But mechanically, the way the deal is structured forces GAAP accounting to recognize an additional 7 million shares immediately.
Oh, wow.
Yeah.
So let me make sure I am following this. 7 million shares just suddenly hit the balance sheet, which means next quarter's earnings per share gets instantly diluted. It is just an artificial weight on the bottom line.
Precisely. And management knows this looks terrible. The CFO practically walked everyone's expectations straight into the basement during the Q&A. He guided that standalone Q4 net sales will probably scrape the very bottom of their negative 2% range. And he explicitly said, expect EPS to hit $2.20 or lower.
And if you are just a retail investor skimming the headlines next quarter, you are going to see that EPS miss and completely freak out. You will miss that it is essentially just a technical side effect of buying a sauce factor.
Yeah, it's a pure optical illusion, but it gets even more complicated when you look at the tariffs, because management actually expects a rare EPS tailwind next quarter from a direct tariff refund tied to that La Regina volume, roughly 3 to 4 cents.
Okay, a tailwind. That is finally some good news.
Well, partially, because the CFO also warned they are really struggling to claw back similar refunds from their third-party vendors. Campbell's gets a check directly from the government, but their other suppliers are quietly pocketing those exact same tariff savings instead of passing them down the chain.
Just holding on to the cash. That is really rough. And, you know, it kind of shows you the raw reality of the food business right now. Even a massive giant like Campbell's doesn't have the leverage to bully their own partners.
No, they don't. The suppliers know, actually. They know exactly how tight everything is. If Campbell's tries to push too hard, they risk losing the capacity entirely. And right now, shelf availability is everything.
Which brings us right back to the beginning, right?
Yeah.
They are willing to completely halt their own promotions just to keep products on the shelf. I mean, looking forward, how long can they possibly maintain this kind of defensive posture before it really breaks consumer habit?
Honestly, probably not long, because they're stepping right into a massive inflation trap next year.
Wait, worse than the current tariffs?
A lot worse. Management flat out said if oil holds near that $100 mark, they are looking at 5 to 6% core inflation rolling into fiscal 2027. It just trickles down into packaging, freight, fertilizer.
Wow. Up from 3% base inflation, right? So they are doubling their cost pressure just as they've run out of levers to pull. I mean, last quarter, they halted their share buybacks. This quarter, they completely canceled the shelf promotions. What is left?
Right. The easy options are shrinking. And if you look under the hood at consumer behavior, it is already bending. Even their core goldfish volume dropped a bit this quarter.
The canary in the snack aisle.
Yeah, the cheddar canary. But they did note that multi-packs spiked 6% over the last few months. So the demand is still there. Families are just heavily trading into bulk value formats to protect their own wallets.
Which is perfectly rational. But to your point, if your core customers are counting every single penny at the register, you really cannot hike shelf prices to cover that incoming 6% inflation wave. You just have to eat the cost.
Exactly, which is why that heavily depressed Q4 outlook we talked about makes total sense now. You can only engineer your debt metrics and cut your marketing for so long before you actually need to sell more food to survive.
So, stepping back, it feels like, look, you do have to give management some credit here. They secured the Rouse supply chain with the La Regina equity stake. They are fiercely protecting their balance sheet. It is a highly intelligent retreat.
It is. I mean, they are managing the reality elegantly, but it is still a retreat.
Elegantly managing the retreat. That should probably be the title of the annual report.
It would save us a lot of reading between the lines.
Well, we will be watching closely to see if that strategy actually holds up next quarter. In the meantime, I might just go hoard some goldfish multi-packs, just in case.
Probably a very solid Macwell hedge right now.
Seriously. All right, we will wrap it there for Campbell's. Thanks for hanging out and thinking out loud with us, everyone. So,
If you want these earnings drops to just show up for you, you might want to follow the feed. And just as a quick aside, we do use AI to help draft the show. It's basically how we comb through hundreds of pages of overnight pilings without entirely losing our minds. But the takeaways are all real. We're always looking for what to cover next, so shoot your ticker request to earningsunscripted@datamadness.ca or just grab the X link in the show notes.
See you next time.